This week on Wealth Track, maverick bond investor Stephen Smith studies countries and currencies around the world to find bonds worth investing in. What's he collecting now for his top-performing Brandywine Global Opportunities Bond Fund? A Wealth Track exclusive with great investor Stephen Smith is next on Consuelo Mack Wealth Track.
New York Life, along with Mainstay's family of mutual funds, offers investment and retirement solutions so you can help your clients keep good going.
Additional funding provided by Loomis Sales, investors seeking exceptional opportunities globally, and Wintergreen, your home for global value. Hello and welcome to this edition of Wealth Track. I'm Consuelo Mack. How worried are you about the bonds in your portfolio? If you've been listening to many of our Wealth Track guests, you are probably very concerned. Several of our recent great investor guests have called the bond market extremely dangerous and risky. After a 30-plus year bull market in bonds, they see little upside and plenty of downside potential. Of course, they are mostly referring to the U.S. bond market, U.S. Treasury securities in particular, which have already seen signs of weakness. But this week's guest has a different approach. He runs a top-performing global bond fund, and he says there are plenty of opportunities in the fixed income world, especially outside of the U.S. He is Stephen Smith, longtime lead co-manager of the five-star rated Brandywine Global Opportunities Bond Fund, which has delivered stock market-like returns over the years, as exemplified by its performance over the last 3- and 5-year periods and since inception. As Smith points out, the advantages of going global are enormous. If you thought U.S. Treasuries have had a good run over the last 10 years with their nearly 5% annualized total return, consider Australia's 12% returns, or Canada's 9.7%, or Poland's 9%, or Sweden's nearly 8% performance. It turns out among nearly 20 government or sovereign debt markets, the U.S. was toward the back of the performance pack. Another benefit of going global, the improving credit quality among developing markets. 20 years ago, only 2% of emerging market sovereign debt was rated investment grade. That means with bond ratings of BBB or higher from the ratings agencies. The rest were not. Fast forward to now, 60% of emerging market government debt is rated investment grade. Only 40% is not. Bonds of Chile, China, Malaysia, and Poland rival those of the U.S. and other developed markets. So where is Stephen Smith finding value in global bond markets now? He says it all begins with the story of the market. I asked him why that is so important for him to understand as an investor.
Well, I think it's really important that you have some kind of a context or framework for your strategy. And you know, in the last number of years, you could have written a book about this year of living dangerously. You could have written it after Lehman Brothers. You could have written it in 2009, 10, 11, 12. And I'm not just saying that tongue in cheek, but we've had, you know, Greece went bankrupt. You have the European malaise. You had a nuclear meltdown in the third largest economy of the world, in Japan. You had to deal with the sequestration. So how do you actually, as an individual, take all this in? And, you know, it would almost be exhausting.
Right.
And so what we did is, first of all, when you just look at the environment, I didn't know, probably like most other people, after, which I thought was the worst policy error in 80 years, Lehman Brothers leaving them go, if we were going to have a depression or not. And so what you needed is a framework to say, okay, we are not. And what happened is the third week in February of 2009, Bernanke had this expression of will. He put a stake in the ground. And he said, I'm going to guarantee all the bank commercial paper, CDs, and any corporation that wants to issue commercial paper will guarantee it for 3 years.
Yep.
Now, the bears may have taken that, and they may still be bearish, but you could say that was a tremendous expression of will. And I just say, look in the rearview mirror. The rest is history. And so with that, we had a financial crisis. And the financial crisis was twofold. One, we had a misallocation of resources to the real estate sector.
Right, all those housing loans.
And then secondly, we had a misallocation of resources to big government. And so the way you get out of the real estate crisis is you don't build more houses, and the way you get out of a crisis of big government is you don't actually increase taxes. And so when you just go look at that context, one of the issues you had is very simply this: what was the real estate crisis? And this is extremely important. In 2008, the GDP was approximately, $12.75 trillion, and we lost $8.5 trillion in wealth. And the average consumer was wed and had a lot of his wealth wed to real estate.
Right. These are paper losses.
These are paper losses.
Right.
And 28% of homeowners, they were underwater on their mortgages. And so Bernanke studied the recession and the depression of the 1920s. And this was the framework. Bernanke could not afford to have the banks or the U.S. citizens continue to have deflation. And so he just set on a path, and his goal was he wanted asset prices up. Now you can sit and argue about QE1, QE2, QE3, we may have QE6, but at the end of the day, was he successful? Mm-hmm. And you just look at it from 2006 till today, we've had 2.75% inflation. And then you just go look at the storyline. The stock market, after that enormous hit, is now up over 125%.
Right.
And now you've got real estate prices up year over year, almost 11%. So we would argue that what he needed to do was establish collateral. Because if you establish the collateral, you then create confidence. And so to me, I think Bernanke has been extraordinarily successful.
So the story, when you look back at the financial crisis and how everyone was really panicking, and even at Brandywine Global, I'm not saying you were panicking, but the Opportunities Fund had a rough year, right, in 2008?
Right.
But you didn't. Did you recognize the story then? In fact, that there was that Bernanke had put a stake in the ground, and that in fact that was an essential part of the turnaround, and therefore we will invest accordingly.
What we did when Bernanke had that expression of will, and you had corporate bonds yielding 400 or 500 basis points more than treasuries, you had the Australian dollar, a lot of the commodity currencies were down 30%. We felt it was time that the information risk versus the price risk were wrong. And what Bernanke wanted was he wanted asset prices up, and he was going to do whatever it takes. Now, the interesting thing to me is as this thing moved forward, you then ended up in a crisis in Europe. And so what we've been thinking about all along is leadership, that leadership matters. And so he provided the guiding light.
Right. So what's the story now as far as the story of the market? And I know that a key question, and you just mentioned it, was, you're saying your key theme was Ben Bernanke successful? What if Ben Bernanke is in fact successful?
Right. And it's hard to have just one leader. But luckily, Draghi.
Right, Mario Draghi, right.
He graduated ahead of Bernanke. MIT, sort of out of the same cloth, really understands markets, understand what we need. So then we had another leadership position. And then, lo and behold, we actually have a politician that's showing leadership, is Abe decided to get out of 20 years of deflation.
Right, Prime Minister of Japan.
And you can see, does it make a difference? And I would say yes. And so a year ago, we started to ask the question, what happens if Ben Bernanke is successful?
And being successful means what?
Well, being successful means we have a self-sustaining economic advance.
Okay.
And so,
without very much inflation?
Right.
Lower unemployment rate?
Right.
Okay.
So a self-sustaining economic advance means that the government can withdraw its stimulus, the economy creates enough jobs, and that the unemployment rate continues to fall, you don't have much inflation, and people develop a sense of confidence that we're not going to have a recession. Because I would argue all along, because of economic policies, that this is about confidence. And so we just keep thinking, well, if Bernanke is successful, where is the misallocation of capital? And so when we look at the world, we would say U.S. Treasuries, German bonds, and gilts, which are supposedly the store of value, and for people who don't, gilts are British bonds, that those are the bonds which people think are safe havens that we
Right.
think have the most risk.
Okay, so that's a misallocation of capital for people to be investing in those government bonds of the U.S., the U.K., and Germany. That's the wrong place to be at this point.
Right.
If Bernanke is successful, if in fact the economy recovers. Okay.
Now you have to think about, why are people doing it? Well, if you experienced 2008 and the market went down, and what's been happening, which I find is absolutely fascinating, and I try to talk to financial advisors about this, when I go and you look at since the recovery began in June of 2009, you go ask a panel of people who are investment people, and anywhere between 25% and 37% of them say, in the next year, there's going to be another tail risk event. And basically what that means is another Lehman Brothers or another depression.
Right, and this is supposed to happen once every 80 years, but they're saying now in the next year, and these are professionals,
These
right?
are professionals.
Right.
So people are all worried about risk. And so they have rich people say, I don't want to lose my money. I see that state pension funds have 42% of their money in bonds because they're just worried about risk. And so the question really on the table is that if you've been spending the last 5 years worrying about risk, what happens if Bernanke is successful?
Right.
And so you just have to think, in other words, it's not like reading the headlines today.
So what are the headlines going to be?
Well, I think what's going to
6 to
happen
9
is
months, or...
unemployment rate is going to continue to fall. Housing prices are going to continue to go up. The equity market's going to be okay. And just like in the last year, there has been U.S. Treasuries last summer had a double, in my opinion, a double top in prices. Yields fell 1 basis point below where they were on December 18th, 2008. And interest rates are up in the Treasury market by over 50 basis points. I would ask you this, has the world come to an end? No. Is the equity market up? Yes. Are real estate prices up? Yes. And actually, even the question, is the consumer actually going into debt and borrowing? He's still not doing that. And so things are getting better. What's happened in the corporate sector may change its mind. Individuals may change their mind for risk appetite. And then that would just mean that Bernanke is going to have less and less he's going to have less and less conviction about buying $85 billion worth of treasuries or agency paper, every month.
So the story really is fundamentally changing. So we've gone from a risk-averse market to one that is basically rewarding risk-taking, and you think that's going to continue. So therefore, how do you invest in an environment like that as a bond investor? Okay.
Well, as a bond investor, a couple of years ago, one of the reasons we were very fortunate is we had a lot of long bonds. Our duration was, over 8 years. In other words, we had a bond portfolio with, 20-year average maturity or more. And now we've cut that duration in half. And the reason we've done it is because of this worry about success. To me, it's like the natural order of things. If Bernanke is successful, would anybody in the listening audience be surprised if T-bills went from 0 to 1%? I don't think so. Mm-hmm. Not if the unemployment rate's coming down, the housing market's doing well, and you are actually creating jobs. Now, the reason we have a better shot at this is if you think about when I mentioned about a politician, Abe. He finally said, enough is enough. It's the third largest economy of the world. They want to have growth.
Right.
And so at the margin, that's going to make a difference. You think about Europe. Europe has been in a recession. And even somebody in kindergarten would have known, why did they go into recession? When you think about 2011, Trichet was the chairman of the central bank, and what was he doing? Tightening, raising interest rates. What's that do? Slow the economy down. Secondarily, when Berlusconi was in office, out of office, and they finally threw him out, they brought a technocrat in. Now, we've studied this historically. It's just that the press, and most people don't believe this, but if you cut government spending, when we did the research on Canada in 95, Sweden in 93, Spain in 77, there was 9 instances of this after World War II. There's no correct method. But generally speaking, it should be $9 in government spending cuts to $1 in tax increases. So not only did they raise rates, but what Italy did is they did $8 in tax increases to $2 in spending cuts.
So therefore, you knew, in fact, that Europe would be in a recession and
Right.
it would, right, for a fairly long time.
What would you expect?
Right.
Absolutely. And the fascinating thing, and that's why this business is an art, is that when you raise interest rates, they lead with a lag, which basically means that when you raise interest rates, it's going to affect the economy with a long lag. And so what happened is Draghi had to put up with the after effects of just poor policy. But now we're at the point where, as an investor, you could say Europe last summer was very, very, very bad. And now it might just be very bad. And maybe a couple weeks or months from now, it might just be bad. But when you move from very bad to bad, less bad is actually good. And that's why the equity markets have been going up. That's why interest rates have been coming down. And when you just think of the word trust, it's really important. Draghi hasn't even done anything except he did the same thing that Bernanke did. Last summer, he had an expression of will. He put a stake in the ground. He said the euro is here to stay.
Right.
And the rest, again, is history. And I would argue the bears have been fighting it. I could sit here and give you a great bearish story, but I just look at it. We have now come to the point is that central banks, they're big, they're powerful, and they can move markets.
So if the story of the markets now is that risk is going to pay, that economies are coming back, that things are improving, what do you do as a bond investor? And bring the global, the aspect of you're a global investor into this as well. How important being able to invest globally is too.
Well, this is extraordinarily important, but you have to understand I have a bias because I've been doing this most of my life. And the reason global is so important is that every country is at a different point in the business cycle. Like the U.S. has been struggling to grow, whereas you do have some countries like Turkey, Russia, Mexico. In the last year, those countries, some of them have been growing 4.5%, 5%. And so they are at a different point in their business cycle relative to where the U.S. is. And the reason this is important is that if you just look at a country like you would a corporation.
So your largest weightings basically are in Mexico.
Mexico is our largest weight.
Right. And so why is that?
Well,
why Mexico?
Well, if you think back, say, 6 months ago, I could have the choice of buying a bond here with a 2% handle for 30 years, or I could buy a bond in Mexico with 7%. And you think, well, is that a risky investment? Their inflation rate and our inflation rate are exactly the same. Their debt as a percentage of GDP is around 41%. Ours is 82%, a little over 80%, and the president doesn't feel that we have a spending problem. Not only that, we have a big trade deficit. They're basically running a very, very marginal trade surplus. And their economy the last 2 years has been growing between 3.5% and 4.5%. They had a change in a political party there, and so, as again, leadership matters. They're doing a lot of supply side things that I think are going to invigorate the economy. So I would just ask somebody, why would you not want to own a Mexican bond with yields 2.5 more times than a U.S. Treasury?
Because of the political risk?
Because of
they're still an impoverished country, because of the drug cartels and the drug wars. I mean, all of those things, they matter too. So how do you figure that into the equation?
There is no question under the Calderon administration there was 58,000 people, killed in the drug cartel.
Right.
But it's in a very, they're in areas that are away from where the manufacturing sector are.
So the economy was not affected.
So the economy
Right.
is not being affected by it. And so you just go look at it from the standpoint of their wages are about $3.50. Wages like here haven't gone up for almost a decade. They're now competitive with China. 10% of all the cars in the world are actually built in Mexico, so they've moved up the chain. And what's more important, Consuelo, is that their short-term interest rates are 3.75%. They actually have a yield curve. They have not had to manipulate they have not had to manipulate interest rates to zero to sustain their economy. And so as a global bond investor, I could look at Brazil, where short rates are 7%. I can go into Australia, where short rates are 2.75%, Poland 3.5%. So around the world, there are a lot of countries that haven't had the real estate crisis, haven't had what we had,
So what do we do for our one investment for a long-term diversified portfolio? What is it, the one thing, and with this new story of growth, what's the one thing we should be investing in?
Well, having done this for, now I hate to say over 4 decades, I had actually thought about a year or so ago that the natural order of things is all of our portfolios are long only. And not that there's anything wrong with that, but what we've been doing is we've been becoming more and more defensive. In other words, we've been selling almost all our corporate bonds are sold, almost all of the treasuries are sold in what I would consider the store of value markets. And we have been reducing risk, raising cash in the anticipation that the markets are going to go up. And so a lot of people would say, well, Steve, that's not going to make me a lot of money. But sometimes it pays to play defense rather than just offense, because it might just pay to be patient and tap your toe. And so I've been telling people that, as a global bond manager, maybe the thing you might want to consider is going with a strategy where you can short bond markets, or if you feel really vitriolic about a currency, go short certain currencies. And, as a way to, make money in a world of low interest rates, and particularly if Bernanke is successful and the world gets lifted and interest rates gradually move higher.
And so looking around the globe as you do, are there any countries that stand out, for instance, that are going in the opposite direction, that are where interest rates are going to go lower? Or is this pretty much a global phenomenon where interest rates are going to start trending higher?
No, as inflation falls, there are countries, as you say, you can get 7% rates in the front end of the Russian T-bills. You can get 7% rates in Turkey. You can get 7% interest rates in Brazil.
And these are countries that you've invested in the government bonds of those.
And you can get 7% interest rates in India. So as you would say, reduce your risk in the U.S., the question would be, well, gee, are these really risky investments? And I would just pose the opposite side of that. If I buy a 1-year T-bill at 7.5% in each of these 4 countries, if nothing happens, I get 7.5%. If I do it in the U.S., I get 10 basis points. So I could even be slightly wrong on the currencies by 1 or 2% and still get a better return than a 10-year or 20-year or 30-year treasury. And so it's all trying to look at what are the risk-adjusted returns, and you can actually end up having a fair amount of cash, 25-30% of your portfolio actually earning a handsome rate of return over and above what the inflation rate is here in the U.S.
So that would lead me to ask you, for one investment for a long-term diversified portfolio, is maybe I should be investing in some of the government bonds of the countries that you mentioned that have their short-term interest rates that have much higher yields.
Right, because they're in a different, what I was trying to get the point is they're in a different point in their business cycle than the U.S. is. And so by holistically looking around the world, you can capture that. So what we do is the world is our oyster. And so you're just looking at, if I have $1 to invest, do I want to put 2 or 3 pennies in India? Do I want to put 2 or 3 pennies in Russia? Do I want to put 15 pennies down in Mexico? Do I want to take all my money out of long treasuries, which we've done a long time ago, because we don't think that they have value? And so this is just the way you manage money. And, just like I said, started this about the year of living dangerously. I don't know what's going to happen in the next 6 months. I know there's going to be a couple of crises, and they will probably create opportunities if you actually have, cash on the sidelines waiting to take advantage of that. And so that's basically what we do for a living. And over a long period of time, it has been a very, very successful investment strategy.
That it has. So Stephen Smith, thank you so much for joining us from Brandywine Global Opportunities Fund. It is a treat to have you on WealthTrack.
Well, thank you, Consuelo.
At the conclusion of every Wealth Track, we give you one suggestion to help you build and protect your wealth over the long term. This week's action point is think globally in your bond portfolio. We just heard Steve Smith at Brandywine explain how his ability to invest in the government bonds of foreign countries with improving finances, economies, and currencies has enabled him to outperform the markets and competitors over the years. We should certainly be taking advantage of those fundamentals too. Among Morningstar's other favorites in the World Bond category are funds run by WealthTrack guests, including Michael Hassenstab's Templeton Global Bond Fund and David Raleigh's Loomis Sayles Global Bond Fund. Given the dominant position that heavily indebted countries have in traditional global bond indexes, this is one area I would recommend investing in an actively managed bond mutual fund. And speaking of the same, next week we're going to argue the active versus passive debate with two pros who are very familiar with both strategies. Vanguard's Daniel Wallach will present the active side, and Gerstein Fisher's Greg Fisher will weigh in on passive strategies. If you would like to watch this program again, please go to our website, wealthtrack.com. Premium subscribers can see future programs 24 hours in advance, and additional interviews with WealthTrack guests are available in our WealthTrack Extra feature. And that concludes this edition of WealthTrack. Thank you so much for watching, and make the week ahead a profitable and a productive one.
New York Life, along with Mainstay's family of mutual funds, offers investment and retirement solutions so you can help your clients keep good going.
Additional funding provided by Loomis Sayles, investors seeking exceptional opportunities globally, and Wintergreen, your home for global value.